Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be covering 5 stocks with ex-dividends next week. So next week's dates are October 23rd through the 27th. So we're going to be talking about 5 stocks with ex-dividends next week. If you buy the stock on the date prior to the ex-dividend date, you will then be eligible to receive the dividend payment for that specific stock. So let's go ahead and we're going to be covering whether the stock is overvalued, undervalued, look at its 1-year, 5-year growth, its payout ratio, its dividend history. I've included a couple other financial metrics that I like to check. I like to look at its revenue, its free cash flow, its net income, and its price to book value. As a value investor and dividend investor, I like to look for a price to book value of under 3, and that's what we're going to be taking a look at. You actually see my very first stock there, but I'm going to take that out for you for just a second. So, of course, if you are brand new to my channel, I do make financial, stock market, and investment videos weekly, so do consider subscribing. I'll try and make this video quick. I think I'm going to be covering a couple really good, interesting stocks that are going to be worth at least investigating a little bit further and seeing whether they are a buy. So, the very first stock is CVS, and CVS is the largest. It provides pharmaceutical and healthcare services in the United States. It is one of the largest providers of prescriptions and related healthcare services in the nation. So right off the bat, I like to take a look at its 1-year price and dividend yield. Are we getting a good, say for the average for the year, are we paying more or less than what it's been averaged at? And we can see right off of the bat that its yield is sitting at 2.64, whereas it's probably average for the year right around 2.25%. So we're getting a very nice yield in comparison to its current price. We can see that for the past couple of months, though, you can see that this price jumped. It dipped from $81 down to nearly $70 before bouncing up a little bit back to $72. So it may have hit its support at around $71, $72, and has bounced back since then. Now, right now, looking at this information, I can see that it looks to be undervalued. But again, that's why I've included my other metrics here. So we're going to be adding our revenue, free cash flow, and our net income. I'm going to be changing this to percentage change. And we're going to go ahead and leave it at 5 years. So in the last 5 years, you know what, I'm going to go ahead and put the price in there. We can see that the price was at the highest between 2015 and about mid-year 2016. Whereas we can see that the revenue is the orange line here. The revenue has had a very nice steady increase. That's very nice. For the past 5 years is actually up 46.8%. We can see that the free cash flow, which is this red line, took a dip in between 2013 and 2015, but the actual stock price had increased during that time. And then as of 2015, it's had a very nice increase and had a very nice spike in 2016, 2017, and maybe something was FDA approved. That's definitely something to look into. What has made their free cash flow increase by 104% in the last 5 years? And of course, looking at their net income, it's had a very nice steady increase for the last 5 years at an increase of 37.6% over those last 5 years. And then as a last sort of metric here, I like to take a look at its price to book value. And as a value investor, you're looking at a price to book value of under 3. And at this current time, this company is at a 2.1. At its highest peak, I was rated at a 3.25%, right around there, not percent, 3.25. And of course, I am going to be making videos on each one of these metrics that I do kind of cover, because I think that's very beneficial. I'm not going to try and cover it now because that would just really draw out the video. So we've already taken a look at its 1-year, 5-year, and one thing, let's go ahead and cover this CVS stock. One thing I like to take a look at is also its price to earnings ratio. It's 14.47. Its dividend yield is for 2.75. Now over on Reuters, you can do a search for CVS, and this website is really nice. I primarily just use it for getting the industry average and the sector averages for its price to earnings ratio. And you can see that for the specific sector, its industry average of PE is 21.51 and its sector is 16.8, whereas this stock is a 14.47. So again, in the specific industry and sector, this is priced at a very nice price to earnings ratio. Now for the last area I like to take a look at in this sort of soft check for these 5 ex-dividends next week, I like to take a look at its payout ratio. It's 34%. That is much less than 60%, which is where I like to look at. So very nice payout ratio. They pay out $2 annually per share. They've had dividend growth for 9 years, since 2008. So during that 2008-2009 sort of recession that took place, they may have stopped increasing their dividend for a year or two. We'll take a look at that. So 2008, their ex-dividend date is on October 23rd, so that is Monday. So if you want to earn dividend paid for this specific stock, you would need to buy on Friday or prior. So far, it is looking like a very undervalued stock. You would then be paid on November 3rd. It's had annual growth of dividend by 21.4%. That's very nice dividend growth. You know, I like to look at stocks between 5 and 8, but 23, hey, I'll take it. So back here in 2008, there was a bit of a, 2008, 2007. So you can see here in 2007, they did not have a dividend increase from 2007 to 2008. They did have a stock split here in 2005, and they continued to pay out 4 cents per share. So instead of cutting back their dividend pay when they did a stock split, they continued to pay out the same dividend pay that they were paying out per share. And that's probably why they had a pullback, or just they didn't increase their dividend between 2007 and 2008. But then since then, they have had a nice steady increase for the past 9 years. So this is what I normally like you see here. They were paying 3 cents per share. They did a stock split and they split it down. They were paying 1 cent per share after that time, but then they bumped it up to 3 cents. So very good historical looking stock. It looks like it has sometimes where they might do a stock split. They'll continue to pay out the dividend paid that they were paying out per share, but now you have double, so you basically double your dividend payments. It is qualified dividend. What else are we going to be taking a look at? So that looks like it for that stock. Now that one does look undervalued. It looks like a great stock to purchase. Definitely do your research into why it had that dip of around $10. Next stock is APOG, and that's APOG Enterprises, and it's basically it designs and develops class products, services, and systems. So again, we're taking a look at its price and dividend yield. Currently, let's go ahead and look at its 1 year graph. For the last year, you could have bought this at a very nice price of around $40, but it does look like it kind of sways up and down quite a bit. We're actually, for the year, it's semi undervalued. You're probably getting it at an average price. If you were to hold it right now, it may trend back down into the $42.50. So I would probably wait a little bit to see if it would hit $42, $42 range, or yeah, $42 range seems to be its support for the past year. This one could continue to kind of trend up. You can see that it's dipped below and then picked back up, dipped below and picked back up. So at this time, it's semi undervalued, but let's take a look at its revenue, free cash flow, and net income in percentages. And this one, for its 5 years, how is it going? So its revenue has had a nice steady increase of 72%. Its free cash flow has had a huge spike. It's up 887% within the last 5 years. And its net income change is 348%. So this stock is definitely on the up and up. So let's take a look at its 10 years. So 10 years, it still has really nice data. You know, it's not, nothing's in the negative. You want me to show you a quick stock that's in the negative? I can show you GE here. Let's see here, not GE. What was it? Oh, I typed G. That's why. So GE, as you can see here, for the last 10 years, GE is actually on a downwards trend. It's losing revenue, it's losing free cash flow, it's losing net income. So all those investors out there that are invested in GE, that could not be a good long-term buy, just letting you know. And then the last thing I like to take a look at here is its price to book value. Is it under 3? And I'll look at just for the 5 years, and I want to change this back to not a percentages. So Right now, we're sitting at 2.67. So, as a value investor, I like to look at stocks again under 3. This could be a potential buy. You know, it has good revenue, good cash flow, good net income. Everything's increasing year after year. Of course, I do want to investigate it a little bit more. So, but right now, it does look semi undervalued. This could be a good buying opportunity. So, next, we're going to take a look at its price to earnings ratio, which is 17.1. You know, it's under that 25, 20 to 25 right now. That's kind of the norm and standard in some of the industries. So this one's sitting at 17.1. Its industry and sector price to earnings ratio is so industry is 24.0 and sector is 16.8. So this stock, it's slightly over as far as the sector goes, but it is a very nice growing stock. Where I don't have anything selected up here, so it's, you know, it's free cash flow between 2015 to 2016 jumped, you know, huge amounts. That could be due to, you know, it's a glass company, so housing, as more houses are being built, as more businesses are being built, buildings are being built, more people are wanting to, you know, glass is just about everywhere, vehicles, housing, all sorts of sectors. So very nice, very nice. And then the last thing is dividend history. What is its payout ratio? And payout ratio is very low, 16.5. That's very low in comparison to what their earning potential is. They've had dividend growth for the past 5 years. You see they're general contractors. So their ex-dividend date is also on Monday, so you will need to own them on Friday or prior to be eligible for that dividend pay. You would then get paid on November 8th. They've had annual growth of 13.6. That is very nice. Taking a look at their dividend history here, they have kind of sporadic, but let's see here. So they've had dividend growth since 2012. So that is what I want to look at. I want to look at 2012, what took place here. So 2011, 12. So they had a little sector here between 2000. What looks like 2008 to 2012, they had no dividend growth, but they continue to pay dividends. So that could be a good stock. You know, it's not one of the best stocks that raises it through recessions, but they definitely didn't do a pullback and they didn't cut their dividend. And they have enough earnings per share right now. Their revenue, their earnings, they're only paying out 16.5%. So even during recession periods, this stock could definitely continue to pay out dividend. And they are qualified, meaning that you would only pay 0 or 15% based on your tax bracket on your dividend income. And then you can see here that they pay 25711, 26711. So they do have very consistent dividend payments. So APOG Enterprises, another good stock that could be a potential buy. So that's a really interesting stock. So the next one, our third stock, is Lowe's. And I do own Lowe's myself. So that's just sort of a, let's see, what am I doing here? Original. There we go. So we're going back to its 1 year. So right now, it's priced at $81.05. It's had a very nice increase within, say, the last, since September. It's had very nice growth. They went from $72.50 to $81.05. You know, it's in my portfolio. I saw it dip in price during that Amazon announcement with Whole Foods. I bought it on a dip, and then it dipped again when Amazon announced something else. You know, I think their earnings were released or something, and they mentioned Amazon. But Lowe's and Amazon, they're in completely different sort of, you know, Lowe's and Home Depot, they're on their own sort of area. When you're thinking of home maintenance and projects, you know, I would always go to Lowe's over ordering or even going to Amazon to consider buying anything I would need for my yard. So Lowe's and Home Depot, very good stocks. Right now, it's $81.05. It is overvalued at this current time, but if you had bought it back in July, September area, where its yield was sitting over 2%, you could get this stock at around 72.5%, and it's jumped up maybe around 10% since that dip. So at this current time, it is overvalued at this time. Now, again, we like to bring in these other metrics here, change it to percentages, And say for the last 5 years, Lowe's revenue has increased by 34.3%, its free cash flow has increased by 92.4%, and its net income has increased by 57.8%. So very nice growth within the last 5 years. We can take a look at the last 10 years. Its revenue and net income has had, it's had a decent increase within the last 10 years, but their free cash flow has increased by 1.3 thousand, basically. That's a huge number in comparison to their other numbers, so it kind of abbreviated there with a K, thousand. So very nice. Lowe's, very good company here. And price to book ratio. So at this current time, it has a price to book ratio of 12.1%. So as a value investor, you may not be interested in the stock at this current time. This one, let's see, 1 year. Okay, yeah, it doesn't matter what you take a look at here. Its price to book ratio is very high at this current time. As a value investor, you may not see Lowe's as a good value opportunity. So whereas CVS and APOG have been under 3 price to book ratio. Next, I like to take a look at its PE ratio, which I believe is under 25. Yep, 22.86. And if we take a look at it in its industry, please wait while we are loading. It's okay, so its industry average is 25.2. and its sector is 16.82. So as far as sector, it is a bit high on the price to earnings ratio, but I believe Lowe's is a better buy than some of the other stocks that are out there. If you could get in on Lowe's at a great buying opportunity, this stock has good potential for growth. It's very resistant to recessions, and we're going to be taking a look at its history here. Its dividend history, its payout ratio, and its dividend history. So payout ratio is very low, 36.4% for its payout ratio. It has very nice earnings per share, 4.51. It did beat its last earnings. I believe, I have my memory doesn't do very well when I have a lot of stocks that I'm always looking at. Dividend growth, 54 years of dividend growth. So definitely resistant to the past 3-4 recessions. So very good long-term buy in stock. Its ex-dividend date is on October 24th. You would then be paid on November 8th. It's had annual dividend growth of 23.5%. Very nice dividend growth. You can see in the past, even during stock splits, they have continued to increase their dividends and pay out dividends in a very every 2, 5, 8, and 11. 2, 5, 8, and 11. It's very normal, and they have, of course, qualified dividends. So very good stock overall. It's not currently undervalued. It is overvalued at this current time, but look for those dips, especially when you see Amazon in the news. This stock does tend to take a bit of a dip when Amazon is mentioned in the news lately, so that could be a good buying opportunity before it bounces back up. I made a video on this where it lost 6% at a time, and I think that was like a week or two ago, and I made a video on it, but man, has it bounced back since then. So very nice stock. Next stock is our Clorox stock, CLX. And of course, Lowe's, it's a home improvement retail chain in North America. And as of 2012, Lowe's operates over 1,745 stores, and it serves 14 million customers a week. So very good information there. Clorox, the Clorox company, is a consumer and institutional product maker. Clorox operates 4 business units, including cleaning, lifestyle, household, and international. So taking a look at its 1 year, we're bringing in the original. Okay, so at this current time, Clorox is another good long-term buy. This is one that I took a look at. At this current time, there hasn't been any good opportunities to buy. I became a dividend investor back in May, and the stock at the time was kind of overvalued. It's still overvalued. You can see that Its average yield is around 2.55. It's sitting at 2.46. Its price is 131. It did take a bit of a dip here, so that could be a good opportunity to buy at the stock, but there's more, there's other stocks. Anyways, let's take a look at its revenue, free cash flow, and net income here. And let's take a look at 5 years and its percentage change. So revenue is up 7.9%, cash flow is up 8.8%, and net income is up 22.5%. So this is a blue chip company. We'll say for 10 years. In the last 10 years, its revenue is up 13.2%, its cash flow is up 13.75%, and its annual net income is up 52%. So very nice growth for the stock. And you can see that for the max, I don't like to use that. I just like to look at 10 years. I don't usually go any more than 3 years at a time, because you can kind of base how a company's going to be doing in the future based off just 3 to 5 years. If we bring GE back in here, for the last 3 years, it's been on a downwards trend. For the last 5 years, it's been on a downwards trend. So that's what I like to look at, current data. And then we'll take a look at its price, or its price to book value, and it's currently sitting at 31. So very high price comparison to its book value. So as a value investor, you may not be interested in the stock, but again, it could be a good buy. So let's see here. I'm going to be right back. Okay, and I'm back. So we were talking about Clorox. So next we're going to be taking a look at the Clorox PE ratio and see how it compares to the sector and industry. So right now, the price to earnings ratio for that's CenturyLink, I want Clorox, which is CLX. CLX is 24.69. So we go over to our routers over here, we type in CLX. I wish this one was slightly faster. The website seems a bit slow at times. Okay, so we can see that the industry average for Clorox industry is 55.8, and within the sector it's 16.8. So Clorox would be somewhere on the higher end, as we have said. Right now it is on the over average, or overvalued at this current time. So that price to earnings ratio, you'd be buying a very expensive stock compared to its earnings. And but it does have good revenue, free cash flow, and net income. Now looking at its payout ratio in dividend history, Clorox has a 60% payout ratio, which again, I like to look for dividend stocks to have a payout ratio of 60% and under. That way they can continue to pay out dividends for the future, and they're not, they're able to reinvest some of their earnings back into their company. This company, Clorox, has had dividend growth for 39 years. So that is quite a while. Their ex-dividend date is on October 24th, meaning that you would need to purchase the stock on Monday or prior to be eligible to hold the stock on the ex-dividend date of Tuesday, and then you would be paid on November 13th. They had an annual growth of 4%, which is slightly under where I like to see the dividend growth. I normally like to have it at 5 to 8% at least, somewhere between there, if not higher. Higher is always nice, but annualized growth for the last 3 years is around 5.2. So, they have had continued growth for 39 years, and it's above 5% annualized growth for the last 3 years average, so that would be fine. Now taking a look here, you can see that even during stock splits, the stock splits that they did have in 97 and in 1991, they did a 2-for-1 stock split, and then they continued to pay out 20 cents per share. So initially, they doubled the amount of shares you had, and then continued to pay you out 20 cents per share. So if you were making $100 in dividend income, you would then make $200 in dividend income because your shares would have doubled. They also do have qualified dividends, meaning that you'd be taxed at the long-term dividend. Here, I forgot what the correct wording is. Let me just look it up real quick, because that'll... A qualified dividend is a type of dividend in which capital gains tax rates are applied. these tax rates are usually lower than regular income tax, so it's normally taxed at the long-term hold. So that is our fourth stock. Now our last stock is Williams Sonoma, which is ticker symbol WSM. And Williams Sonoma is a nationwide specialty retailer of high-quality products for the home. These products are represented by 8 distinct brands. So we have Williams Sonoma, Pottery Barn Kids, PB Teen, West Elm, and Mark and Graham. Actually, there's Mark and Graham, Rejuvenation, and Williams Sonoma Home. So these products are marketed through 600 stores, 7 mail order catalogs, and 6 e-commerce websites. So I think that was a very nice bit of information there. This is a company that I hadn't really looked into in the past. So I can see that it has had a downwards trend down into the $43 range back in September, but it's up at $50.75 right now. So that would have been a great opportunity to buy it in September, where you could have got a yield of 3.5%. So let's see here. If I want to go in just a little bit closer, we can see that it is currently overvalued at this current time. You can see that the yield is sitting at 3%. But if you had bought it at a time when it was $40, $43, right around that price, a yield of 3.5% or a little bit higher, you would be sitting on a good growth of around, what's that, nearly 15%, somewhere around there, and then sitting with a 3.5% yield for what you paid. So that would have been very nice. Now taking a look here at the revenue, free cash flow, and net income in percentages, we can see that this stock for the last 5 years has been moving up. So we'll say, we'll look at, in the last 3 years they've been kind of going down. So in the short term, we can see that they've kind of moved slightly down, but overall in 5 years, 5 years ago it'd be 2012, this company has moved their revenue by increased their revenue by 27%. They've increased their cash flow by 104%. They've increased their net income annual change percentage by 18.95%. Maybe in the last year alone they may not have increased their net income, but it does look like they still have been increasing their revenue, which is nice. All their earnings per share and their revenue. So that's been moving up on a nice upwards trend. And you can see for the last 10 years their cash flow has been moving very nice. You can see in comparison to their price here, let's see, their price percentage change is down here, 83.81. So let's see here. That's pretty nice. Their free cash flows, that's kind of spiking. That's pretty nice. Let's see here. What is next? Take a look at their PE ratio. So this is WSM. Their price to earnings ratio is 14.6. That's pretty nice. Now let's look them up compared to the sector and industry. So WSM. You can actually see here that they have products and they have retail stores in the United States, Canada, Puerto Rico, Australia, and the United Kingdom. So they are pretty well spread, as well as having 2 segments in e-commerce and retail. So another company to consider if you're looking for something a little bit cheaper than Amazon that's in a bunch of different sectors in a bunch of different countries. This could be an interesting one to add to your portfolio. You can see that for the industry it's 28.1 and for the sector it's 16.8. So this company is below the industry and sector price to earnings ratio. So that could be a good buy if you got it at a good opportunity. Again, that good opportunity would have been back in around September timeframe, when you could have got this price or this stock for around $43, which is really nice. And let's take a look at its dividend history. So WSM, So it has a payout ratio of 43.5. It's had dividend growth for the past 7 years since 2010. So we're going to take a look at why, what happened. Did they have to cut back? So their ex-dividend date is on October 26th, so that is Thursday. So you would need to purchase the stock on Wednesday or prior to be eligible on the ex-dividend date, and then you would be paid out on November 22nd. It has annual growth. Its dividend annual growth is 5.8. Annualized growth for the last 3 years averages 8.3. So that's very nice annual growth. Now I wanted to look at 2010 to see what their dividend did. So here we can see that they may not have paid dividends. Yeah, you can see that they started paying dividends back in 2006 during the 2008 sort of market correction, the market correction that took place. They didn't pull back their dividend, but they did increase it, and then they have been increasing it ever since 2009, 2010. So you can see they had an increase from 2009 into 2010. They increased it by a cent, and then they actually increased it the next quarter again to 15 cents, and then so on. So they do pay out a 43.5% ratio. You would have to look, looking at their free cash flow revenue and such, they do look like they are they're growing. One thing I didn't check was their price to book value, and it's 3.6, so you're paying 363% premium for their stock. So if it was 100%, one for one value, you would be buying their stock at an equal price to what their assets they have on books. So right now you're paying a premium of about 363% over, but that's pretty normal. Or not pretty normal. You can see that CLX here has a 31.4% price to book ratio. Lowe's has a 12.19. APOG we saw had a 2.6, and CVS had a 2.1. So as far as value goes, CVS is looking like the best value for your dollar. You're paying a premium of 217%, but it's not too bad in comparison, as you can see, to these other sectors. But this is one, so if I had to pick two to kind of investigate, I would mark CVS as probably my number one to look into, followed behind by APOG, and then CLX and Williams-Sonoma. So we know that CLX and Williams-Sonoma were overvalued at this time. I believe Lowe's was overvalued. So we had 3 overvalued stocks, 2 undervalued stocks, and CVS and APOG. They both had really good price to book values, but they do require a little bit more studying because of this price dip. This could be a good opportunity to buy into CVS. So that is it. We have covered 5 stocks with ex-dividends next week. We had CVS. We have them right there on the left-hand side. CVS Health, APOG Enterprises, Lowe's Companies, CLX, and Williams-Sonoma. If you were thinking about buying either one of those 5 dividend stocks, go ahead and let me know in the comments below which one you would have picked, or which one would you pick if you had to invest in one of the 5. Which one would you pick based off just sort of the information that you looked at today? Of course, I'd always advise checking out Yahoo Finance and other information. Check out their annual report, their quarterly report. See what kind of see what they're up to in the next quarter, what they've done in the last year, and so on. So that is it for this video. Hopefully it wasn't too long, and of course I do want to thank everyone for watching up until this point. If you liked the video, hit the like button below, and please remember to subscribe for future financial videos. If you have any questions, go ahead and leave that in the comments below, and I will always reply. Thanks for tuning in, and I will see you next time. Bye.